Alright, welcome back. In this very lesson, we're going to be working on risk and money management for beginners. I know that I've discussed leverage and margin earlier on, but I'm going to just do a recap of what we did and possibly run a few calculations. And then position sizing, we've discussed that quite, should I say, extensively, because we have used it. How to calculate our position size and margin per trade. We just did it in the lesson on the trading process. Now, using stop loss and take profit, we have used that. Using trailing stop, this is an area I want to quickly deal with first. Using trailing stop to erase risk per trade. Let's quickly get to the trading platform and I'll show you how to do that. Okay, now you see that the thing has is retracing back already. Now, using trailing stop. Trailing stop is a tool that you can use to eliminate risk of loss. When a trade has been placed and is moving in your favor in the direction that you speculated, one of the first things to do, because it's a volatile market, anything can happen, is to protect your trade when it has gone in your favor, so that a winning trade does not turn into a loser. Some call it risk erasure. So trailing stop is a tool that can be used to do that. For instance, now selling at 1.5640 with stop loss at 1.5664, well, that's 24 pips. I can decide to erase this risk of 24 pips and make it that if anything happens and this trade goes against, it will not lose anything. That means it will just be break even. Okay, and also you can use that like when you are chasing an enemy. After you have protected or defended your territory, you cannot chase the enemy to wherever he's running to. So to activate trailing stop, just right click on the trade that is running. Here is the trade. I just right click here. Now you select trailing stop. That's the tool. When you select it, currently it's set at none. When you activate it, the stop loss here will now turn yellow. Once it's moving your favor, it will turn yellow. But if it's going against you as it's moving, it could begin to turn red. But let's quickly check that. Right click, select trailing stop. Now first, let's select a trailing stop of, you see you have 15 points, 20 points, 25 points, up to 50, and you can put custom. Usually I advise, for long-term trading, medium and long-term trading, that the minimum trading stop to use for medium and long-term trading should be 50 points. Because when you are projecting for a long time, maybe up to 200 pips or 300 pips, that may last for several days. Okay, when you move your floor for 50 points, for 50 pips, you may adjust move trailing stop to break even. You can do it manually. For example, now I may decide to just use modify or delete order, and with that I will just shift my order. Or alternatively, now the drag and drop, the drag and modify stop. If I just say here drag this, you can't adjust the entry again because the entry has already been activated, but you can adjust the stops. If I want to adjust the stop loss, I can just come here and move it, drag it manually to the entry price. Okay, if I release it there now, it will take it and shift the stop loss. You can see it there now, but let me take it back. All right, okay. Now if I want to now activate trailing stop, I could just right click. Now let me use 15 points, that is very close by here now, so I could just activate 15 points. Now it's golden color, and watch, it's now it has moved. You can see that 15 points, it just dropped the stop loss from 58 to 1.5658 to 1.5650. Now at every move now in favor of this trade, if it goes to 16, this one will drop to 49, 1.5649. If it, as it keep going, it keeps following it at giving 15 points gap, you can see it that has dropped. So that is how to use the trailing stop. As this trade is now, even if things go a hurry and it turns out to be against the position I've placed, then nothing is lost. You can see 17, it has now dropped to 38. But one thing about auto trailing stop is that it can only go forward, it doesn't go backward, meaning that if from here now price turns against you, you will just come there and meet it there and it will take you out. All right, so then about leverage, I've discussed this earlier, that leverage is important. High leverage, I don't encourage it. Maintain 1 to 20 leverage. All right, leverage is like a loan. Do not abuse it. When you use low leverage, go with like 5% margin. So your leverage is and your margin work hand in hand. For example, now 1 to 100 leverage means that you are accepting 1% margin. That means that for every position you take, all right, that you will commit 1% of that position, whatever the value of that position. I don't know if you understand me. For instance, now this trade, remember 0.01 is 100 units, multiplied by the price, you get 100 by 1.5640 will give you 155 or 156.4. Now when you have that amount, that is how much you are required to put down as deposit. But because of leverage, we chose a leverage of 1 to 20. That means I'm going to provide 5%. 20 in 100 is 5%. So 1 to 20, give me 5%. So I'm going to provide 5% of that value. So 5% of it is what give us 7.82. All right. So if you choose 1 to 1000 leverage, it means that you are providing 0.1%. 1 to 400 leverage, you are providing about you are providing about less than about 0.25%. Okay, so that is how leverage and margin go hand in hand. And also, now let me quickly talk about equity here, which I didn't list there. Now, equity, still talk about your risk. This is what tells the true story about your account. Now, equity is simply the balance you have here. Watch it, this balance and equity. Balance plus profits is equal to your equity. So if profit is negative, equity will be lower than balance. If profit is positive, equity will be higher than balance. For instance, here you see that profit here is 0.25 and balance is 99.68. So equity has risen to 99.92. Then free margin. Free margin is simply the available margin that you can still use to look for more opportunity. It's a function of equity and margin. It's a function of equity and margin. For instance, your equity here is 99.94. When you subtract the margin that has been committed to this trade, you'll be getting what you see here. So equity, as long as what you do, subtract equity from this. Okay, you know that equity fluctuates. Alternatively, subtract margin from balance. Whatever you have, whatever you now be adding and subtracting the profit, so you'll be getting your free margin. So either way, either you just subtract margin from equity, as it fluctuates, you get your free margin, or you subtract from balance the profit here, and then you subtract from balance the margin. So with the balance, you now be adding and subtracting profit to it to determine your free margin. That's what's still available for you to take another trade. Margin level is an indicator for margin call. There is a level, for example, when the margin level falls below, in some cases 20% or 10%, you get a margin call, which is a call or a message by the broker asking you to replenish a position that has so moved against you. All right. Now, position sizing, of course, I've discussed that earlier, that when you are taking a position, always work out the position size will determine the margin level. Position size in relation to the leverage will determine your margin, the margin used. Okay, so position size is the same as volume, and this is one tool that is going to help you to stay long in this market and learn all that you need to learn to become a long-term profitable trader. All right, so when you want to calculate your position size and margin per trade, I think we did that before we placed this trade. Go and watch that video on the trading process, one of those series there, you find it there. Okay, so thank you very much. I trust that you have picked a lesson or two, and if you have any more questions on this, you just send me an email. God bless you and see you at the top.